Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Today we're going to be covering a popular topic, which is what to do with your excess cash. We've had a lot of clients coming to us saying, I've got excess cash in my savings account. Should I be using that to either pay down debt or should I be investing it trying to earn a superior rate of return? And the answer is it depends. And it depends on the number of items that we're going to be covering today, which include what is the interest rate on your debt? What is the funding level of your emergency fund? Do you have any big one-time expenses planned over the next 12 months? What is the status of your various financial goals? How close are you to retirement? What type of economic environment are we in? And then also I'm going to share with you some of the debt secrets that our high net worth clients use when deciding to either pay down debt or invest. All too often we see people make the mistake of just blindly investing cash hoping for a superior rate of return when they should be really using that cash to pay down debt. And this is coming from an investment advisor. So I'm going to be walking you through today some of the conversations we have with clients to kind of reach that decision as to whether they're paying down debt or whether they're investing their cash. The first question we will normally ask a client is, what is the interest rate on your debt? Whether it's a mortgage, whether it's a credit card, because we in the financial planning world look at the interest rate on debt as kind of like a risk-free rate of return, because we know if you use cash to pay down that debt, you are not going to be paying that interest to a bank or someone else. An example of this would be if you have a credit card balance with, let's say, a $10,000 balance on it, and they're charging you 15% interest. Every single dollar that you apply extra towards those payments is technically earning a 15% rate of return because you're not paying it to the bank. So if you were to go out and instead use your cash to invest it, you would have to be receiving over a 15% rate of return for it to make sense to do so. And it's not an apples to apples comparison from a risk standpoint, because we know for sure if you pay down that credit card, you're gonna get that 50% rate of return versus the markets. It could go up, it could be flat, it could be down. You gotta take more risk to kind of hurdle that 15% interest rate. The decision is much more difficult when we're talking about lower interest rate debt. Like if we're talking about a 3% mortgage, do I use extra cash to pay down that mortgage, or do I try and get more than 3% by investing in the market? Now, this is where those other variables that I talked about at the beginning will come into play that I'm going to cover now. The next item that we ask clients about is the funding status of their emergency fund. And what emergency funds are is just cash sitting in the sidelines on a savings account that if some unexpected life event happens and you have to write a big check, spouse gets laid off, there's a big medical expense you weren't expecting, you have to replace a car, something of that nature, you were able to write that big check without upending your entire financial plan or without having to go into debt and then dig out in order to meet that unexpected expense. So what is the appropriate funding level of an emergency fund? We typically advise clients to have at least 4 to 5 months worth of their total living expenses that just sit there in cash to absorb those unforeseen financial events. Now, any cash over and above that amount, there's an opportunity cost to holding too much in cash. The opportunity cost is that cash is probably earning less than 1% sitting in your savings account, where it could be working harder for you or earning more doing something else with it. A common example is, let's say a client has $50,000 sitting in their savings account. We run their emergency fund calculation, and the emergency fund says they should have $30,000 sitting in cash. So that means they have an extra $20,000. That's what we would consider excess cash that should probably be doing something else with, whether that's further funding a college 529 plan or putting money into retirement accounts, not just to help subsidize retirement savings, but potentially to lower their tax bill. But there are clients that'll come to us and say, well, I don't want to take any additional risk with that excess $20,000. That's okay. The next question we'll ask is, do you still have a mortgage? And they say, yes, I have a mortgage, but the interest rate is only 3%. Well, if you're only getting 0.5% of that extra $20,000 sitting in your savings account, and if you apply it to the mortgage, you're now paying down debt at a 3% rate, you're technically getting a 3% rate of return on that money, it may make sense to do so. So far, we've assessed the interest rate on your debt, the funding of your emergency fund, and the next question we typically ask is, do you have any big one-time expenses that are going to be coming up within the next 12 months. Because if you have big expenses such as you're planning to buy a house, or you have tuition payments that are going to be due, or you're going to be doing home renovations, many times it may not make sense to let go of that excess cash because it's tough to know what's going to happen within the next 12-month period. If you pay down debt, that cash is no longer available to meet that one-time expense. And if you invest that cash, while markets behave in a more regular pattern over 10-year periods, it's much more difficult to predict what's going to happen to either the stock or bond market over shorter time periods like 3 months, 6 months, or a year. If interest rates ever get higher again and you have access to a 6-month CD or a 12-month CD, that may be a viable option for that excess cash because it's within that time constraint of those one-time expenses. But be very careful about fixed annuities. Sometimes fixed annuity rates will look very attractive, but a lot of times fixed annuities have surrender schedules that if you take the money out within a certain number of years, they hit you with a surrender penalty on the way out. The next place we go is asking our clients about the funding status of their various financial goals. So some of the common ones are, when do you plan to retire? Are your retirement savings adequate? Do you have children that'll be attending college? What is the status of the college savings accounts? If you just bought a house and you have a family, do you have enough term insurance that if something happens to you, there's enough insurance coverage to provide for your family? Or things like if you're going to be in a higher tax bracket this year, maybe we should be focusing more of your cash to retirement accounts to help lower that tax liability. Having this excess cash creates kind of an opportunity to say, where are the weak spots in my overall financial plan, and can I shore up some of these weak spots by allocating some of this cash in a strategic way? The one factor that does weigh very heavily as to whether we advise clients to either pay down debt or invest is how close they are to retirement. So normally as our clients approach retirement, we do strongly encourage them to pay down more debt. Now it's tough in really good economic environments because they see the stock market going up 10% plus, they've got a 3% mortgage, they're like, Mike, why would I ever use my cash when I'm earning so much more in the market? The reality is once you're retired and we've built these retirement projections that have assumptions about your rate of return, inflation, your life expectancy, could there potentially be a long-term care event? All those assumptions are just estimated guesses. But what happens when you retire and all of a sudden the economy goes into a huge recession and you get basically a 0% rate of return for the first 6 years? You didn't have that in your plan. So all those assumptions you have no control over. What you do have control over is how much you're going to be spending in retirement. That's the constant. So we can kind of say by reducing that amount as much as possible, if some of those assumptions don't work out the way they're supposed to, having lower expenses provides you with some flexibility. The type of market environment that you're in when making this decision definitely comes into play, because if you're in a very robust economic growth cycle, you might feel more confident that you're going to be able to hurdle your 3% mortgage rate by putting that money to work, and whether it's stocks or bonds or other securities. But if you're in very uncertain times where there's a lot of gray area, it's really tough to see how the markets are going to be behaving going forward. You just take on a lot more risk by investing those assets versus taking that guaranteed rate of return that's offered by paying down your debt. The last item that I'm going to touch on is really more of a debt and wealth accumulation strategy that I've seen many of our high net worth clients use that I think can be applied to really any wealth level. And it's pretty simple. It's basically these high net worth clients, because they have no debt or they have very little debt, it affords them the opportunity that with their excess cash, they can take more risk with it, which allows them the potential of obtaining higher rates of return and accumulating wealth faster than the average investor. If someone has no debt and they have $90,000 worth of excess cash that they want to put to work and grow, they may decide, because they don't need the $90,000 to subsidize their expenses, and even if it went to zero, it's not going to completely change their lifestyle, they might choose to do something more risky and invest in maybe 3 startup companies, $30,000 a piece. Now there's the risk that all 3 startup companies go bust, but again, it's not going to upend their financial picture. But there's also the opportunity that maybe 2 of the startups go bust, but if one of those startups goes public and then it gets a 10x return on the investment, that $30,000 investment now went to $300,000. It subsidized the other two that went bust, and plus it generated a huge return for that client. Someone that has debt and thus corresponding expenses associated with servicing that debt might find it difficult or even unwise to engage in a similar strategy, because if those investments go to zero, now it's upended their entire financial plan. Now, investors that are successful don't just blindly run around and start throwing money at every high-risk investing, hoping one of them is going to make it. They actually really do their homework, but it's really that overarching concept that if you're applying money towards debt now and potentially accepting a lower rate of return in the short term, that may later on open up the opportunity that because you have no debt, it allows you the opportunity to take potentially more risks, which could lead to much, much higher rates of return down the road. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.